Here's a situation you'll probably relate to. You sit in front of your screen. You watch a trade inch closer to your stop loss. Your heart beats faster. You feel that twist in your stomach. It grows stronger as the price dips against your position. You tell yourself that you must act, but you hesitate. You wonder if you should close your trade early or wait. Hundreds of thoughts spin in your head. Then you see the market push more against you again. You then click to exit with trembling fingers, and the loss hits your account. You then feel a wave of regret and even shame. And then you begin to blame yourself. Every trader knows this feeling all too well. This moment captures one major burden, the fear of losing. You worry about your capital vanishing. You might dread blowing up your account. You might keep your trade open out of stubborn hope. Or you might rush to exit too soon from panic. That fear can turn you inside out. It can freeze your mind. You might stare at the chart, hoping it will turn in your favor. Yet you do nothing at the right time. This fear steals your clarity. It blinds you to good choices. It pulls you away from your trading plan. It makes you question your skill and your worth. You see, loss is scary. When you see a big red number in your account, you might lash out at the market. You might get angry, or you might make reckless moves. Revenge trading can happen with such anger. You try to hunt for a quick fix. You slam into the market again with full position size, hoping the next trade wipes out the loss. But this rarely works, and your initial loss, well, it just doubled. Greed is another item in this puzzle. You see a new hot stock, or a new cryptocurrency, or you see a setup that looks like an easy jackpot, and you enter, hoping for a quick gain. If it goes right, you might celebrate too soon. You might become overconfident. If it goes wrong, you might chase more trades. You try to get that same excitement back. This dangerous hunger often leads to overtrading. You hop into the market with random entries. You break your rules. You ignore your risk. You guess blindly and hope to find gold. And at the end of the day, when you look at your account, you see red, and lots of it. Boredom can strike too. You sit for hours. You watch the prices scroll. You want action. You decide to take a trade with no plan. That boredom-driven trade often spells trouble. The market does not care that you are bored. The market is busy living its own life. This leads to slippage in your discipline. It leads to trades you cannot explain. Then you wonder why you clicked the button in the first place. You ask yourself if you can even follow a simple plan. Many also struggle with analysis paralysis. You stare at your charts. You flip through indicators. You read one more tweet. You watch one more video. You second guess your plan. Should you wait for a pullback? Should you switch time frames? Should you tweak your settings? Your mind becomes a storm of what ifs, and you watch your setup pass. Price moves in the way you predicted, but you did nothing. Then you feel frustration. You feel that you missed a big gain. Next time, you promise yourself not to overthink, but you do the same cycle again. Some traders face unrealistic expectations. They think they can double their account each week. They dream of perfect trades with no risk. They think they can live on an island next year. They see social media gurus brag about new cars, so they put on giant trades to chase giant wins. And their account blows when reality sets in. Pressure is also constant. You might see your friends posting gains. You might hear someone boasting about a big Bitcoin run, and you want to keep up. You fear missing out, and you jump in at the worst time. Then price dips, and you feel foolish. You might try to buy dips again. If it keeps dipping, you panic even more. Then you regret not waiting for a clear signal. Your mind flicks between fear of missing out and fear of losing. That internal conflict leads to emotional whiplash. All these struggles hurt your confidence. You think trading is all about charts, But you see that your mind can sabotage each decision. You see that you are dealing with your own emotions as much as you are dealing with the market. This reveals the truth. Trading is a mental game. Charts, indicators, and systems matter. But your mindset decides how you use them. If your mind is locked in fear, or stuck in greed, or swayed by anger, you cannot follow even the best plan. It all starts with your psychology. The invisible battles you face each day are shared by all of us who trade. Each fear, each mistake, each wave of guilt is part of the common trader story. Traders often ignore their own plans. Initially, they craft a step-by-step system. They detail entries, exits, and risk levels. Yet in the heat of the moment, they throw it all out. They see a quick jump in price. They chase it. Then they see a large drop, and they exit in a panic. Their trades become impulsive. And this leads to confusion. It leads to random results. Your plan is just a piece of paper with no use. You might obsess over a single trade's gain or loss. You might celebrate a fast gain, or you might dwell on a sad loss. You measure your worth on that one outcome. Then your next trade falls into the same trap. You react to the last result instead of thinking of the long-term path. But you see, even a person with a strong system can fail if they get stuck in short-term thinking. At the beginning of the day, you knew you had a plan, yet you let a single good or bad result shake you. Emotional trading is widespread. Fear, greed, frustration, envy, they circle within you. You might have a plan that says to risk 3%. Then you panic and risk 20% because you feel it is a sure bet. Or you might bail on a winning trade too soon because your heart pounds with fear. You see, emotions can override logic. This type of trading sets you up for chaos. It erodes your discipline. Chasing losses is another pattern. You might take a trade and lose. You feel a sting of shame. You want your money back, so you jump in without a plan, hoping to recoup your loss. That trade might fail too. Now you feel even worse. You doubled your losses, and you keep throwing money at bad setups. At the end of the day, you wonder how you ended so deep in losses, and you blame the market or your luck. But the truth is your choice, fueled by anger and desperation, led to that. Overconfidence can arise after a streak of wins. You might feel invincible. You might think each setup will be a winner. You might raise your size too fast. You might skip risk measures. Then the market humbles you. One large loss wipes out all your gains. And you feel shocked. You wonder where your luck went. Then you blame the market gods for punishing you. But once again, you ignored your plan. You took on too much risk. You forgot that losses can come at any time. That is the root of the problem. Confirmation bias leads you to filter the information you see. You might want to go long a stock. You read only bullish news. You skip the warnings. You only see charts that confirm your view. If you find any bearish sign, you dismiss it. Then the stock tanks. You are caught off guard, and you feel tricked. Yet you tricked yourself. You closed your eyes to other angles. You chose to see only what matched your bias. Traders also fall for the sunk cost fallacy. You analyze a setup for a whole day, and you enter. But it goes south right after you enter. You think, I've spent so much time on this, I have to wait. And you hold, ignoring your stop loss, because you feel you are too invested. You cannot stand to accept a loss. You might even add to the losing position. You hope it will return to your entry. You linger on that bad trade far too long. The problem is you don't want to admit the trade was flawed from the start. These behaviors create a loop of poor results and stress. You keep falling into the same traps, ignoring your plan, letting emotions rule, chasing after losses, or riding that wave of overconfidence. You make the same mistakes over and over. Awareness is the first step. All these actions come from within you. Once you see them, you can address them. You cannot blame the market. The market simply moves. Your job is to control you. Traders often get hooked by the promise of profit. That excitement triggers dopamine in the brain. Dopamine is a chemical that influences reward-seeking actions. It is the same chemical that can lead a gambler to keep pulling the slot machine lever. You see a potential big win, and your brain lights up. You feel a rush of anticipation. But this rush can override reason. You know the feeling. You see a setup and imagine fast gains. You might ignore your risk rules. You might jump in with no caution. Your mind wants that thrill. This pattern can repeat itself like an addiction. Each time you open a new trade, you get a jolt of possibility. You crave that rush again. But this can spawn overtrading. You chase setups that are not aligned with your plan. Stress also plays a major role. When a trade goes against you, your body can release cortisol. That stress hormone primes you for fight or flight. That works well in physical danger, but in trading, it can cloud your judgment. Your hands might sweat, your heart might race, your mind might fixate on the potential loss. You might exit a good trade too soon out of panic, or you might revenge trade. You are just reacting to stress signals in your body. That reaction is not rational. Over time, you can get mentally tired. Watching charts for hours is draining. Making many decisions is also draining. Decision fatigue sets in. The more you force yourself to focus without pause, the weaker your willpower becomes. You might make silly errors. You might misread a chart or place the wrong order size. Knowing these bodily and mental processes can help you pause. You can feel when it is dopamine or stress driving you. One helpful approach is journaling. This is a way to bring conscious thought to your actions. You note what you felt before you took a trade. You notice if you felt an urge for a quick high. You notice if you felt fear. Writing it down makes it real. Then you can reflect. Over time, you see patterns of behavior. You see exactly which trades were fueled by an emotional rush. You see which trades were calm and planned. Trust me, tracking your mood will help. It's like keeping an emotional log. You rate your anxiety or excitement levels at certain times, and you note it in a journal. This might feel odd, but it highlights hidden patterns. Maybe you are always extra impulsive after a few hours waiting for a signal. Maybe you are anxious when your trade doesn't move much. By noting these patterns, you can avoid big trades when you are prone to tilt or frustration. Remember this. When you trade, you want to break the dopamine highs and the cortisol lows. You need to bring your trading back to a level-headed space. Now let's talk about resilience. Resilience means you bounce back after a loss. You do not stay in despair. You do not let it ruin your whole week. You accept that losing trades happen. You focus on the next step. You also do not become too arrogant after a win. You stay steady. You speak to yourself with calm assurance. I know, easier said than done. Unfortunately, resilience is built with practice. Each time you push through a tough day, you are training your emotional muscle. One tool for resilience is acceptance. If you deny losses or blame the market, you do not grow. If you accept that losses are part of trading, you free yourself from shock when they arrive. You plan for them with risk controls. You do not tie your ego to each trade. You see it as a probability game. The focus is on the long run. This acceptance helps you handle each outcome with grace. Another tool is self-awareness. You need to know your triggers. Some traders get overly excited after 2 wins in a row. Some get crippled by fear after a single big loss. Some freeze when they need to pull the trigger. By studying your emotions, you identify these triggers. Then you can plan. You can decide not to trade after 2 wins if you sense overconfidence is creeping in, or you can reduce size after a large loss. Consistency in size and process also fosters resilience. If you keep your position size consistent, you avoid emotional spikes tied to random big positions. If you keep a checklist for each trade, you can measure your actions against that list. When you follow the list, you feel stable because you know you are sticking to a disciplined approach. If you skip it, you see why you got off track. You can correct it next time. Resilience grows when you see setbacks as lessons. Each loss can teach something. Maybe you learned the market was in a different mode. Maybe you learned you were in an anxious state. Maybe you learned your stop was too tight. Maybe you were fooled by a candle or a quick price spike. Instead of letting it crush your spirit, you update your plan. Discipline is more than ticking off boxes. It is following a structure, even when emotions scream at you. You might have a plan that says, I trade only at certain times. I only risk 2% per trade. I exit at a specific signal. Then a big news event spikes the price. Friends on social media are cheering about easy gains, and you feel the urge to jump in. Discipline is what stops you from ignoring your plan. That's why you must always consult your rules. If it is not in your plan, you stand aside. Traders sometimes see discipline as boring. They want excitement. They want the thrill of big moves. But that thrill can lead to reckless decisions. The best traders often repeat the same type of trade for years. They are calm about their routine. They do not chase random markets or trades. They stick to what they know. Their discipline keeps them out of trouble. It might not be flashy, but it is steady. Self-discipline can erode if you let small exceptions slide. You might say, I will just increase size a bit today. It is a sure setup. Or, I will hold this loss beyond my stop, just this once. Each time you do that, you chip away at your discipline. You teach your mind that the rules are flexible. Then a bigger slip happens next time. Soon you have no clear anchor, and I guarantee you will blow your account. Routine is a powerful ally. If you have a pre-trade checklist, follow it each day. Check the market conditions. Check your entry, your potential exit, your technicals. Check your risk and your mindset. After your session, review the trades. Write brief notes. That pattern keeps you grounded and prevents emotional leaps. Sometimes, no trading is the best trading. Some days, you might notice your mind is distracted, or you might see that the market is choppy and does not match your setup. Not trading is also a decision. It keeps your account safe. You see, many traders think they must be in the market always. They fear missing out. A disciplined trader just waits for the conditions that match their strategy. That is how they protect themselves and preserve their capital. Some traders keep scanning social media. They see big wins posted. They see markets that went up a lot. They beat themselves up for not catching that move. They chase hot tips from random influencers. This leads to confusion. It leads to trades with no personal reason. And soon, it will lead to fear and regret. Comparison can turn a stable trader into a frantic mess. Objects in your feed might not be real either. Many people only show their wins. They might hide big losses. Chasing illusions can harm you more than you know. Some people rely too much on gurus. They copy trades they see on a stream. They never learn to form their own plan. They do not have a strong foundation themselves. Blind following leads to confusion. It also prevents real growth. You need your own tested strategy. That might incorporate tips from others, but you must adapt them to fit your style. You must also define your why. Why do you trade? Is it for a secure future? Is it for the thrill? Is it to test yourself? Get that reason clear. Write it down. That reason becomes your anchor. Shifting your mind from winning to improving will help you. You stop chasing big payouts for show, and you start focusing on consistent execution. You might measure your day by how well you followed your plan. If you followed it 100%, that is a win. Even if the trade ended in a small loss, you are building skill. Over time, that skill leads to profits. So limit external distractions. Stay off social media during trading sessions if it tempts you to make random decisions. And if certain forums spark envy or panic, block them. Seek only solid, balanced resources that match your style. It is better to have focused, in-depth practice than to jump at every new idea. If you see something that might help, test it in a demo or small account. See if it works with your plan. Some traders overcomplicate their strategies. They change indicators daily. They tweak settings each time a trade fails. Others suffer from procrastination. Instead of placing trades, they spend hours adjusting lines on their charts. They might fear real outcomes, so they stay in a loop of refining. They never have to face the risk of real commitment. Recognizing these patterns is the first step. You might notice you always close a trade early when it starts to get profitable. You might see that you disregard your rules when you are close to a big milestone in your account. Many times, this self-sabotage stems from the desire for perfection. I said it before, a trading journal is your best friend here. It is a place to record not just your entry and exit, but your thoughts and emotions. You write what you felt before you entered. You note any hesitation. You log your mood, your confidence level, your reason for the trade. Then you note what happened during and after the trade. You might discover that each time you are feeling too excited, you tend to over-leverage. Or when you are anxious, you exit too soon. By reviewing the journal, you see patterns in your decisions. You spot which behaviors led to consistent gains and which led to losses. You might find that you do better in certain market conditions or times of day. You might find that you fall for revenge trading after 2 losses. This awareness helps you create solutions. An open mind is vital. You might outgrow your strategy at some point. The market might change and your strategy might stop working. So keep an open mind and always try to learn new concepts, but do so with a filter. Test new ideas in a small or demo account first. If something seems to help, integrate it. If not, discard it. Please always remember this. A strong mental game is better than having a strong strategy. A trader with a strong mental game will always do better than one with a good strategy. Now, if you want to keep improving your trading game, go ahead and watch one of these videos.